Welcome to Presentation Expressway, everybody. This is Barry Habib going to give you the forecast and outlook for 2018. Well, I'll tell you what, the team at MBS Highway really rolled their sleeves up on this one, crunched a lot of data, a lot of numbers, and here's our look ahead of 2018. You know, pretty much hit it on the head for housing in 2017. A lot of people not forecasting the huge moves up in housing. We're very proud to say we were ahead of it. We did think that interest rates would move up slightly. They did, not very much, but they did, about 0.25% year over year. We did expect that. We did think that the Fed would hike a few times. They did. We thought that the stock market would calm down. That was not to be, though. But let's take a look this year and let's see where we are. So first of all, as we take a look at our crystal ball and take a look at what stocks, bonds, the Fed, interest rates, housing, what's all that going to do? Let's take a quick peek here. So in 2018, the dynamics of the year, as far as we're concerned, what do we think it's going to be? We think that the stock market may finally have a pullback now that the tax plan is in place. How will this affect housing and rates? Well, interest rates could actually benefit from a stock market pullback. As you know, both stocks and bonds compete for the same investment dollar. Now, housing, interestingly enough, probably will have a bit of a headwind because if people start to see their investments in stocks dwindle a little bit, it makes them feel a little less likely to make some big investments. So we think that the housing market, as we'll talk in just a little bit, will be very strong. But this could be, if it happens, a bit of a headwind on the housing market, although rates should improve, which could compensate for that. Now, the Fed's got a new look. They're saying they're going to hike 3 times, but the people that are saying that aren't going to be the ones voting in the new year. There's going to be a new group of people at the Fed. They're going to unwind their balance sheet. Let's talk about what happens to mortgage rates there. Now, we think the rates are set to rise a little bit in the year ahead. Not crazy. We'll tell you how much and what the impact will be. So as we continue to talk about housing and its impressive run, will this continue and will tax reform be a drag? Well, tax reform did reduce the deductibility of a mortgage from $1 million to $750,000. So that's going to hurt us a little bit on the high end. But the real difference here is a little less incentive due to the fact that the standard deduction has been doubled. So it makes renting a little bit more attractive than it used to be and buying a little less attractive than it used to be from a tax perspective. Doesn't mean you lose money buying a home. It just means that renting now is not as much of a disadvantage from a tax perspective. The one that's going to hurt people in those high tax areas, 6 states in particular, California, New York, New Jersey, Connecticut, Illinois, Massachusetts, high tax states, they used 51% of the state and local tax deduction last year in mortgage deduction. Those individuals in those states, I'm in New Jersey myself, are going to be limited to a total of $10,000 between income tax and state and local taxes to be deducted on your federal return. That could be a little bit of a drag on housing. All right, stock market. Let's take a look at that one first. So with the stock market appearing a bit toppy and vulnerable, we're entering into this year with so much investor optimism. Investors are as optimistic as they've been since 1987. It's a 30-year high in optimism, and that's oftentimes a dangerous sign. It's the most expensive stock market on a price-to-sales ratio ever. Here's a chart here, and you can see it is the most expensive market on price of the stock to sales on the S&P that has been ever. The last time it was up this high, well, the year 2000. You remember what happened to the stock market in the year 2000. I'm not going to say that this happens again, but you'd have to see some similarity in this run, and you wonder if there is a bit of a cooling off ahead. So again, we're not saying that this means it's going to happen exactly, but this is something to at least be concerned about. It's also the 3rd longest expansionary stretch in history. As we begin the new year, over 100-month consecutive expansion without a recession, we think that this expansion is getting a little bit long in the tooth, so we have to just kind of be on guard for that. And the yield curve might be telling us something when you see a flattening of the yield curve. When you take the 10-year Treasury minus the 2-year Treasury yield, take a look over the past few years, the trajectory as it gets lower and lower and lower. Currently around 60 basis points, meaning The 10-year yield is 60 basis points higher than the 2-year. But not long ago, it was close to 3% or 2.5% back in about 2014. So this trajectory being lower has to tell you that, let's be on guard a little bit, because if it becomes inverted, meaning the 2-year treasury is higher than the 10-year, what you see historically, every time that's happened, wasn't too long into the future that you saw these gray areas, which mean recession. Our prediction. Look, I think there's going to be a significant stock market pullback during 2018 after such a big run-up in 2017. We feel that it is due, and as I explained earlier in the open, we think that it's a bit of a drain on housing, but it'll be a bit of a help for interest rates. With respect to the Fed, there's a big changing of the guard. Hey, old Yeller, she's out. Jerome Powell's the new sheriff in town, and he's going to kind of continue along the same lines as Janet Yellen. But you know what? He's a pretty sharp guy with some business experience, and he has been very successful. And so I like the fact that he has got some real-world experience. Now, Vice Chair Stanley Fischer and New York Fed President William Dudley, they're both gone too. So if you take a look at the 2017 Fed, number 1 was Yellen, number 2 was Fischer, number 3 was Dudley. They're all out. So it's a big changing of the guard. There's a lot of vacancies. Trump's going to have to appoint up to 4 Fed governors. And it's probably going to be a little bit more of a hawkish Fed. And I know that they said 3 rate hikes, but it's going to probably turn a little bit more hawkish because depending on whom gets replaced, Super Dove, he's a bit crazy. Neil Kashkari, he's out. And then Permadove, Charlie Evans, also gone. And replacing them, the one replacement we know from a voting perspective will be Loretta Meister. She is a hawk for sure. Now, when I say they're gone out of the voting rotation, so they won't be voting members this year, meaning that they'll still have a voice, but it will certainly not be as powerful as someone who has a vote. Now, if we take a look at the changing of the guard, you could see Powell's there, Brainerd's still there, Super W got Quarles in, and look at the appointments that have to be made. This is going to be a very different Fed than we saw in 2017. So you can almost throw out the window anything that was promised, and let's see how these appointments go. And that could be a big surprise this year. The Fed has been known, if they tighten too aggressively, really could send things into a recession. If you think about the fact that they're obsessed with trying to get inflation up there to 2% inflation, and if they over tighten, it could throw us into a inverted yield curve, could slow business down, could be recessionary potential. So we're going to watch that carefully throughout the year. Now, here's the Fed dot plot. As you can see, in 2018, the bulk of them are forecasting 3 rate hikes. Some people are saying, hey, we're going to get 5 or 6 rate hikes. I don't see that happening, but there's always some outliers that are a bit crazy in these dot plots, and they're anonymous, so you don't know who's making these. Each dot represents one of the Fed members' sentiment there, so they're usually all over the place. Team, the Fed dots have been extremely unreliable. The Fed is notoriously bad at forecasting. All right, but the Fed will do something that's really, really important, and this is kind of set in stone. They're going to continue to unwind their balance sheet. So starting October of 2017, they began to reduce the reinvestment of mortgage bonds. They were buying back about $25 billion a month in mortgage bonds, and even more than that in treasuries. So they were very active in the bond market. That was helping to keep yields low. Now, they've already cut that back just a little bit here by $4 billion a month. I mean, it's so funny to use $4 billion to say just a little bit. And, we have seen yields move up just a little bit, right? Well, starting at the beginning of the year, they're going to double their curtailment. So it was $25 billion. Starting in October, they started reinvesting $21. Now they're going to be buying $17 for the first 3 months. That gets cut again to $13, then $9, then $5. So it's going to be a very interesting 2018 without the Fed in the market to keep up that buying. That buying's got to be replaced somewhere. They're out there. Question is how much the yields have to move up to entice that? That's one of the big reasons why we think the rates will move up a little bit in 2018. Probably the biggest reason we think that they will. And here you can see the Fed's balance sheet. They say we want to get it down. Well, they've got $1.8 trillion on their balance sheet. Through all of 2018, all of that curtailment, all that's going to do is take their balance sheet down from $1.8 trillion. It looks like it hardly is going to budge to $1.68 trillion. As you can see, it will take all the way to 2025 to bring their balance sheet to zero. That's their plan. What I'm telling you is this got no shot. Why? Because we're going to have a recession before that. We're going to have tough economic times before that. And when we do, the Fed will have their foot on the gas pedal once again. And what that will do is they'll either do some form of QE, cutting rates, stop this. So this is on paper, and for now, maybe it'll get through 2018, but I'm assuming sometime in here, this will kind of be scrapped. Okay, we are going to forecast 1 to 2 hikes because we feel if the stock market pulls back, that is going to change the Fed's mindset. So that's our prediction here. We're leaning towards 2 hikes, probably the first one in March, one in September, and then we think, although they'd like to do these in December, depending on what the stock market does, that last one will be in flux between September and December. Maybe we get 2 in there. I don't think we're going to see 3 unless Trump appoints a very hawkish Fed. Let's take a look at what interest rates are going to do. Now, you heard me kind of preface this a little bit. Interest rates, we think inflation is the main driver, and inflation should be tame. Because the Fed's not going to be as active, rates will move higher, but not too bad. That QT ramp up, Fed investing less is the main driver. Stock pullback could be a counterbalance there, should help rates a little bit. Our prediction, that 10-year Treasury note yield, 218 to 264 for most of the year. It goes up above 264. We could see yields kind of tease 3% on the 10-year. We think overall mortgage rates will be about 0.3% on average year over year. Of course, could it be a little bit higher at some points in time, a little bit lower at some point? We think the average, if you took it for the balance of 2017 versus what we'll see in 2018, expect 3/8 higher rates on average. Now, what's that mean for you? It means that you're going to see a lot less refinances because we know how sensitive refinances are to rate moves. But it does mean that you're going to have to be purchase-centric. And that's the good news here. If you are purchase-centric, use the tools in MBS Highway. Use our real estate report card. Use the buy versus. Use all the amazing tools that we have in MBS Highway. It'll really help you because the fact of it is housing is going to be phenomenal. We closed out the year with just incredible numbers, both on new construction and on existing homes. This is a market that's got an incredible amount of momentum and strength going forward. And some of the drivers are low inventory. Rents are still going up at 4% a year. Rates rising modestly won't derail things. Even the tax plan making a little bit of a less incentive won't derail things because demand is so strong. Demographics are so strong. Again, that the tax implications, the big one is they kept the exclusion that you have to live there 2 out of the past 5 years. But once again, people that take the mortgage deduction today in 2017, well, that represents just 21% of tax returns filed. I think that's surprising for many people. In 2018, we think just 4% of tax returns are going to take the mortgage deduction. That's because of the doubling of the standard deduction. That will take a lot of the incentive out. Our prediction, 4.5% to 5.5% appreciation on housing. Now, that's overall in the country. We think that will create a lot of wealth. And before you say, 4.5 doesn't sound very exciting, Albert Einstein did say that compound interest was the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it. Think about that. Look, even if it's on the low end of our forecast, and well, I'm very proud that we have been, according to Zillow and Pulsenomics, the most accurate real estate forecaster in the United States out of their top 150 economists. Even if it's on the lower end of our scale at 4.5%, just a 4.5% annual rate of appreciation on a $300,000 home would result in a value of $466,000 or a $166,000 gain in 10 years. Why are we using 10 years? Because that's what the National Association of Realtors says the average time somebody spends in a home. So just think about that. Okay, 4.5% could be very, very meaningful. Hey, want to once again wish you nothing but the best in the new year. Health, happiness, joy. Thanks for being part of the MBS Highway team. Let us know how we can help you. Make sure you explore and use the tools. There's so much in there to help you win in 2018. Listen, to tell you something, it's going to be very competitive this year. Not just amongst originators, but technology. You see Amazon now getting into the mortgage space. We have to be sharper. We have to be a better resource. And that's why we've worked really hard here. The whole team at MBS Highway has worked really hard to give you amazing tools. They're in your hand. Use them. Explore them. Call us. We'll help you as well. Don't forget to use the help buttons. They're dynamic. They'll give you videos on every page. They'll teach you how to use them. I hope you have a great year in 2018. Bye-bye.